All right, good morning, everybody. So we're on the other side. Made it through QRA, FOMC, some of the Mag 7, and we're still here. It's a good start. NASDAQ is leading. Japan down nearly 0.75%. Small caps aren't participating in this rally. It's something I'm continuing to keep an eye on. Down 0.25%. Dow basically flat. So it's the S&P and the NASDAQ. It's very likely that the equal weight S&P isn't going to be keeping up either. It's a part of that broad market move that we were looking for. We don't really want to see the whole market on the back of just tech. We're going to get more jobs data today, but this isn't the big one. Non-farm payrolls is always the big one you want to keep track of. Still, any jobs data goes to the Fed's mandate, so it's worth keeping an eye on. They were even talking about it yesterday in the press. I don't think there's really any surprise coming out of Bank of England. Just like with our meeting yesterday, we pretty much knew there wasn't going to be a cut. On this one, I believe they're looking for a cut over in England. Yeah. Previous 5.25, actual is 5. They did a 25 basis point cut. We're going to get some auctions today on top of the ISM manufacturing and PMI manufacturing. But by the time we get into the afternoon, things should start to look pretty good. Total vehicle sales may cause some volatility late in the day, but that's close enough to where we start looking at MOC orders and power hour moves anyways. And we're still seeing crude bid up from the Middle East. Accelerated tensions. Still don't think crude is going to be a longer term play though. We're in a new month. So a new month, we have the door day 1 open range, and then we have a 3-day door, which is what these two lines are. The yellow candle is when we got a new month, and then marking 3 days of this, the lowest point in those 3 days and the highest point in those 3 days. Even though it's 3 days instead of 1, it's still the day 1 open range strategy. I ran it on the single day. I thought it was fine, but I do tend to like the 3-day better. It's really kind of the similar comparison between if you do a 5-minute open range versus a 30-minute open range or a 1-hour open range, right? It doesn't really matter which one you pick. You just want to stay consistent with it. But we are in a new month. Right now, we got a little bit of a situation when it comes to price analysis and a new trend. If you're what they call a pure price analyst. We set a lower low here, and we set a lower high here, and that's one set. Two of those would be a full set. So we need two lower highs, two lower lows, and then we would have a defined, confirmed downward trend. But we don't have that yet. This move up doesn't count for a lower high because we haven't fallen away from it. Until we do, it's not a lower high yet. And if we continue to rally and we break this previous lower high, then we don't end up with a lower high over here at all. We'll end up with a higher high. Now, that doesn't necessarily mean we're going to go to the top and break out and continue to go farther. It would just call into question whether we're just making this move or whether we're going to come back up and build some kind of longer term basing pattern staying within this channel. So from a pure price perspective, how we resolve this is going to become very important. If we pull back and get back inside this zone, then this is going to be a lower high. But if we continue to rally and we get through this, it'll be a higher high. It'll break the set, break the count, and we'll have to reevaluate at that point. Other analysts who don't want to use pure price will use something like moving averages, a 10 and a 20, and look to see if we're above or below. And then some do both, a little mix of moving averages and a little mix of price action. It's not right or wrong. It's just what you like, what you're comfortable with. But we're in that situation right now. That's sort of the big problem. All of this was IX10. So if it was just one inside day, that's what we would call it, is an inside day. This is the candle in control. That was the inside day. So if it was just this day, that's what it would be. But since we spent multiple days down here, it's IX10. It's where we build up a lot of energy, and we learned that markets build energy in this kind of setup by using the RSI Laguerre. So we see a market consolidate like this, go into an IX10, build up a lot of energy, then the energy gets spent on the breakout. But now that we've got the breakout started, it has to stay above this level. Now we can wick back down in here, even wick down deeply. We still need to close outside this level. If you have an IX10 and you break out of it and then you come back into it, it generally fails miserably. And if you want to think of it a different way, this is the draw. So when we pop out of the draw, if we fail here and come back in, then that was the raid, and we know where we go next. When you get a draw in a raid, they're gathering up liquidity for a run in the other direction. That would also tie in with us getting a lower high, right? If all of this fails, we come back in the box, that gives us a lower high. We would then be looking for a lower low, then we'd have our full set, two lower highs, two lower lows, and our continued move to the downside. Yesterday being the closest candle to us, we want to mark it and take its 50% mark. But yesterday also being a really big bar, we would want to do this. So even if that bar was 3 days ago, it's the biggest bar, we would still want to do what I just did there, mark its 50% mark. We can hit that level, we can go underneath that level, but we don't want to close below that level. Even if we didn't have this box that I drew for the IX10, we still wouldn't want to get and close below this 50% mark. We want at the most a half back rejection where we come down and bounce that level and continue on to the upside. There's still a gap back here. Needs to be closed. $5,600 makes sense. Nice round number. Liquidity resides on the other side of the pivot. So we get through 5,600, we get into 5,602, we get the gap closed. So that's going to be a significant level that we got to deal with. And it lines up with our warning center. If you use fibs, throw a 1.11 on it. On breakouts, if they fail, a lot of times they'll fail around that 111. It's like the midpoint between 1236 and the 100 point. So I generally call it my warning center because it's the midpoint, so the center. And it's where we generally fail, so it works as a really good warning. We've got this midpoint from the entire run. Going to look for that to be a little bit of a support. It's 55.76. We can get below this level today, tomorrow, but we don't want to close below it. So dip down, put a little wick in there, but get back above it, stay above it. What we're worried about here is that after the move was made, that's where we get our measurement from. If we run up and hit it and we get above it just a little bit and then we fall away from it, then it's a half back rejection. And that leads us to the downside. So the fact that we're above it today doesn't mean anything because the day isn't done yet. This could be nothing more than the new candle opened and we're getting some wick first before we flip and go to the downside. That's the concern of today, right? $55.85 is the bottom of the channel. If you think about the gap here that needs to be closed, that's the bottom side of that gap channel. Right now, it's where we're struggling. It's what we hit yesterday. It's what we're hitting and fighting with today, 55.85. And then we've still got these sellers back here in this whole zone that needs to be dealt with. Get through 55.11, excuse me, 56.11 cog line, get on the other side of that 56.32 cog line. That should get us through this sell channel, pave the way for the run back up. But that's a lot of work to do. Spot Gamma last night said that this move did not burn off very much option numbers. So there's still a lot of juice left in the tank. You know, we think about a market making a move and running out of steam or running out of energy. But looking at Spot Gamma's post from last night, there's still a lot of energy left. Still see this high volume node from last week. We talked about it earlier. That 5611 area, high value, high volume node, cog line area. It's going to be tricky to get through that. We're up a little bit, which puts us closer to the upper edge than the lower edge, but we were up more. We were a lot closer to it, and we weren't able to get there. It's a little bit of a worry or a hint of caution in that. It was an inside day breakout that failed more than once. So we got there, we kept trying to take it, couldn't get it. This is a pretty strong magnet, and it just wasn't able to get there. And just like we were talking about out on the daily, now that we've set this high and we've started setting these lower lows and lower highs, we have to get back up and break this one and then break this one or else. So we're getting a little bit of a move here, but we had Europe and everything else. We're going to start to tighten up before 10 because we've got a lot of data coming. And it looks like the market just is waiting on that data. It wasn't willing to commit. That round number 5,600, we weren't even able to get there. So they're front running it pretty solid. We got to get through the data, got to get through this round number. Then we got to get to that ADR. We're on the upper end of the week's pivot point. Generally, we look for reciprocation. So whatever we got on one side of VWAP, that's what we look for on the other. We can take that VWAP reciprocation and apply it to a pivot point in the same way. So there might be a little bit more in here, but not much more. That gets us into 5611 and kind of run out of steam there. Now, it's not a perfect system, right? But we see it all the time where we get reciprocation on a pivot point. Something to consider. Otherwise, when we're looking at the weekly pivot, asking that question, have we gone too far, too fast? No. We haven't gone too far, too fast. We're not due a pullback or any sort of mean reversion simply from that move of yesterday because it wasn't big enough to meet those metrics. Today's channel is higher than yesterday's. That's pretty simple. We haven't hit it today, so that's a missed daily pivot. It won't count today. It'll count tomorrow. And it's a really wide channel, which implies if we do attempt to break out, that the breakout will fail. Just keep in mind that these channels don't move price. So if it's narrow, if it's wide, it can give us some insight on what price is expected to do, but it's not the cause. It's not what made price break out or fail to break out. There's the floor pivot. There's the R1. We're not even gapped enough to be above the R1 yet. So that R1 is still going to act as a resistance, and price hits the pivot point more than 80% of the time. So that's still the base case argument, is that we'll come down and hit that pivot point. 55.32 cog line is underneath it. Kind of makes sense for us to go back. Plus, we have a habit of coming back and hitting it anyways, right? So even though we've gotten pretty far away from it, coming back and tagging it wouldn't be off the table. Here's the cumulative volume index. We kind of talked about this before. It doesn't matter what I have up here. This is looking at the NASDAQ cumulative volume. I put Bollinger Bands around this thing and I added some moving averages, but this big yellow line is what we want to look at. This is the NASDAQ total volume, right? It's either net buying or net selling. If you go to TradingView, you can do the same thing and look at it from all markets, right? So CVI, cumulative volume index. Just open it up, and instead of the one single market like the NASDAQ or the NYSE, you can do all US market. It's not quite at a breakout point, but it's really close. So this is a bullish divergence. Price is not back at the highs and trying to break out, but cumulative volume is. So this is a bullish divergence. Again, this won't make price move, right? This is not the cause of the move that we see in price. But that's a very aggressive, lots of buying yesterday. Back above the 10-week, this measurement that we put in last week still holds. We didn't really get deeper than that, at least not much, maybe a point. So 55.76, we got to keep it. Spot Gamma, yesterday I mentioned that I couldn't get in, and I thought, well, it's a comp account. Probably got to reach out to them and get something fixed. They got hit with a cyber attack yesterday. So it wasn't me that couldn't log in. It was everybody. There was login issues across the board. They did mention it when they got back out again, and they put out their AM founder's note. They mentioned it then. We're back above the 0 gamma volatility trigger. The put wall is still down in the 5,300 area. Call wall is really close to 58. We've got a lot of room on each side, right? We're not squeezed in by those options metrics. 10-day, 20-day, the 3-week, all underneath us. Kind of got a clear path forward if we can keep it. And that's what really they were laying out in the founder's note last night, is that their point of view is that the S&P is strongly above all of the danger levels. And as long as it can keep that, then we're good. The problem is they were using the SPX. Is this go, no go level, that 5,500? We're not very far away from it. So if we cut back down underneath it, you know, there's a gap to close from way down here, 54.36, because we closed there and then we opened way up here, and that's the gap that needs to be filled. I know a lot of analysts will just focus on this empty space, but for me, if we closed here and we opened here, then that is what needs to be closed again. So same thing as on the ES. This point here, 55.84, it's our line in the sand. We do not want to set a lower high here, because if we set this lower high and we pull back, then we're very likely going to set a new low. And that would become two lower highs, two lower lows, and that's a defined trend, a full set. And that puts the anchored VWAP on the table. Because of the moves that we've seen in the last few days, the average daily range net right now is 1.2%, which comes out to about 68 points. The daily expected move is 46 points, and a daily one standard deviation move is about 56 points. So you can see the market is greatly exaggerating its moves. Movement is another word for volatility. So when we're moving way beyond the daily expected move levels, it's just showing that there's a high amount of volatility. In this scenario, you don't want to do weekly iron condor strategies. That's like the main takeaway right off the bat. No strategy that says, I bet you're going to stay in this box, because these are showing that we're not staying in the box. We're breaking our expected moves, moving farther than the market is pricing us to move. Ten-day, 30-minute volume profile, the point of control is below us solidly now. And I had mentioned, as long as we kept chopping around there, it would act like a gravity point, and we wouldn't really look at it as any form of support or resistance. Because when you're just doing this, it isn't a support or resistance. But once we've firmly left the range, either one side or the other, it would then become a resistance level if we went down below this low, or a support level if we went above this high. So this is now a key support level, 5,500. And it needs to keep it. Still got a high volume node overhead. That's where the old point of control was, 5611. It's a number that just keeps coming back again and again. We were looking at it on the daily, the higher time frames, mentioned it over and over, but now we can see that we've got volume there too. Yeah, it's old volume, but old volume, especially since that was the old point of control, is where we know that there was a lot of trading. That's not my bias. It's not my opinion. It's just what it is. That was where the greatest amount of trading was. And the only reason the point of control isn't there anymore is because we built out more volume down here. The expectation is if we come back into 5611, it's probably going to be very difficult to get through there. Whether it's from buyer's remorse, trapped traders, say it any way you want to say it, unfinished business. If the greatest amount of trading took place at that location and we go back to that location, we got to expect there's going to be more trading. We got a new VPOC. From yesterday. It looks like we've already hit it this morning, but it doesn't look like we managed to close through it. It's another really good example of how the previous day's highest volume area often become the next day's unfinished business. So we dropped down into that level and we tested it multiple times. And so far it's holding. We could say that this is no longer a VPOC because it's been hit. I'm willing to, to be flexible on that because we didn't close through it onto the other side. But VPOC just means we haven't been hit. It doesn't say anything about closing on the other side. It doesn't say anything about hitting it in the pre-market or the after hours. Just it hasn't been hit. And this has. So if you want to be a stickler about it and just not call it a VPOC, but instead use it as a POC, it's just yesterday's point of control, whether it's been hit or not. I would have it on the chart today, whatever you give it a label as, because if we come back down here, there's very likely going to be a response in the market at that same spot. Yesterday also, by the way, a classic P shape profile. Which if you've gone through any of the volume profile stuff over the years that has been put out, classic P is bullish, especially if you maintain above that point of control where the D or the bell is at. One and a half percent above the 10-week. Things are still looking pretty good. The sweet spot would be somewhere between 2 and 3.5, right around in that zone. But just maintaining above that zero line is a really good start. We're above 1%. It's even better. So we just want to keep this. We want to see a smooth transition back away from this zone. Nothing really extreme, really fast, like back here. Those big crossovers and extreme moves to the upside. We want a nice, clean, gradual expansion up. So in price, we get the same thing, right? Just a nice, clean, because otherwise, if we outrun the 10, then we'll actually see volatility increasing as price increases, right? Remember, when price goes up, volatility generally goes down. But if we outrun the 10, we'll be moving so fast, investors will get worried about how fast we're moving up, and we'll see the VIX rise because of it. People generally don't fear a market moving or crashing up, right? So we generally don't see the VIX rise when the S&P rises, but it will if we begin to outrun our moving averages. And kind of circling back to that question, did we move too far too fast yesterday? No. This is distance from the 10-day, and we wouldn't consider any sort of overbought or having gone too far until we were at least 1.5% above the 10-day. At least that far, if not farther. And we're not even at 1% yet. So we're not over exaggerated. We haven't gone too far. It doesn't owe us any sort of pullback or mean reversion. This is the range for the week. We're supposed to close inside this box 70% of the time for a typical regular market. The S&P has the most accurate expected move out of any product in the marketplace. So it generally closes in the box about 80% of the time. In periods of high volatility, however, it has a history of closing outside the box. And we know it's a period of high volatility because we've got a 21-day average daily range that is almost 20 points more or 50% more than the average daily expected move. So we're exceeding our expectations, which means we're very likely going to break the range or not close inside the box because we're just moving that much. This is what we want to see with that broad market rally, the rising tide that lifts all boats. That every sector is green. Now, this isn't good enough because some of these are just barely green. 5-day change, but it's a good start. I have to put the moving averages back on. They're not on right now, but I'm pretty sure they're all above their 200 and pretty confident they're all above their 50. That might not be true. I got to put them back on. When I was cleaning house, took my moving averages out of there. We'll get them put back on. But what we see with this white line, which is a linear regression line, is it's not sloping down on any of these. Sure, it might be flattening out on some, but flattening out isn't pointing down. So we want to continue to see that rising tide. We don't necessarily need all these breaking out into new highs to maintain that bullish bias. As long as we're not breaking down below key moving averages like the 50, the 200, and we're 5-day change positive on all of these, then the market is still holding above the, it's holding its head above the water. Bitcoin, uranium, both of those are down. Triple X semiconductors are down, but it was up, 12%. So kind of needed to take a break there anyways. VIX is down. And really that's our line in the sand. Anything less than 0.5%, we don't want to focus on. Looking at what's up. What's up? Mag 7, it's not a surprise. The top names here, FNGU, that's a Mag 7 tool. Then this is a little homemade ETF, the Mag 7. Then this one also another Mag 7. All of those are leading this morning. But not much more than that. And that's kind of where the rub is. We need more than just the Mag 7. So we're getting some move in semiconductors this morning. SMH making a move back up, but we still need to get outside of yesterday's range and really expand to the upside. Just like with the discussion we were having earlier, once we've set this high and we set this lower high and we broke that, we got 2 lower lows. This will be our next lower high if we fall away from here. with yesterday's big move, you want to mark that out on the semis. That 50% mark, 244, would be the line in the sand. And we can already see the box there with that old selling. Get through this halfback, and the anchored VWAP becomes the target. They defended this low. You see that on these 2 wicks. They defended it really well the last 2 times we were down here. And if we look back here, again, where they defended it really well. This kind of lines up as a double bottom. And a really good double bottom is a bear trap. That's what it's supposed to do. Trap the bears. And what we expect when we're trying to define a really good double bottom and a really good bear trap is that we got down into that 111. Remember we talked about this earlier. From a fib level, when breakouts happen, if the breakout's going to fail, it usually fails around that 111. So it just works as a really good tool to check and see if this is going to be a cup and handle or if it's going to be a double bottom bear trap. And then when the trap is triggered, a really good bear trap is you get this pin bar and then you get the follow through bar, this big green bar. So those two says this was a perfectly executed double bottom. But now it's got to follow through. So it's got to get through this high, this 258, call it 258 and a half, or even the halfback, this 259. And I would use yesterday's midpoint as a line in the sand. If you want to be a little more forgiving, then you can use the low from that double bottom and the high of yesterday, because this will count as its own leg. You can measure that. And it ends up being yesterday's open, 238.60. Close enough. 238.75. That spot right there. Otherwise, if you want a tighter one, then 244. Need to close above that. Pot stocks are back up to the anchor to VWAP, but it's been fighting this for a while. That's kind of a really ugly inverse head and shoulders too, by the way. I mean, it's there, but it's ugly. Even if we manage to get through it, I would use reciprocation measures. Whatever we had on the bottom, measure that to the upside. That would be your price target up. So around 4, maybe 4.25 if we overshoot, but I wouldn't expect too much out of pot stocks anyways. That's a legislation play. And as long as legislation doesn't change, we're not really expecting anything in that. It is a part of the Harris play, right? You had your Trump play, and then you got your Harris play. And when Trump play was up at a 75% probability, those trades were really getting a lot of flow. Well, now she's up to 53% probability, and her trades are getting more flow. So, you know, if you're watching the probabilities, the Vegas odds, you'll see that those two trades fluctuate with the amount of flows that they're getting. I still like the Qs back down to this anchored VWAP. You know, we got close, but close doesn't count. Thing is, the MACD is already starting to turn over. It's not done yet. It still needs to cross back above the yellow line, but that low held really solid. So it needs to keep it. If we come back down, it's the same chart, same setup, right? If this breaks that half, then we're going to look to challenge these lows where all these buyers stepped up. Break that, we've got this VWAP down here. And I've been pricing some plays, you know, to put trades on down at that 440, 442 level. Because if you go far enough out in time and that far out of the money, you can usually find some really cheap lottery tickets. And sure, it's a low probability play, which is why they're so cheap. But if they hit, then should be a really great payout, especially with the amount of risk that we have to take for it. So this isn't looking very broad at this point, right? We got pot stocks, nat gas, and the Qs, and that's it. That's not enough. We need to see a broad market participation, lots of sectors, lots of industries, and we just don't have it. So if the Mag 7 get tired today or everybody gets nervous about it again, then we're just going to stall out. I don't think we're going to sell off necessarily because, you know, a lack of enthusiasm isn't the same as negative bias. But this isn't enough. So what I would be watching for today, you can use the visualize tab for this. So got market watch, visualize, get rid of the heat map, swap it to an index. You can choose whatever index you want, even your own little homemade watch lists, but put the NASDAQ 100 in there or the S&P 100. And we want to see issues, which are companies. We want to see that rise higher on the advancing side than the declining side. Otherwise, if we just have the Mag 7 doing all the work, a lot of our breadth tools aren't going to function correctly. Things like the tick, C-tick, you know, the weighted AD. When it's only the Mag 7 doing the work, a lot of these breadth tools just won't read the way they're supposed to read. We want to see that rising tide lifting all boats. So far, so good, right? Keep your eye on the 10-year and the dollar. We're tightly wound here. The dollar above, I know 104 seems like an easy mark, but I would say we need it higher than that. Dollar above 105 would be an issue, or below 104, which seems too easy. But I think going for 103.5 is just too extreme. If we get below 104, we should start to feel it. On the 10-year, 4.0 has been the line for a while. And I mean, is this pretty close right there? 4.04, 4.02 yesterday. How much closer do you need? That's pretty close. So if we start to see some stability in the 10-year, you see that basing out, holding the line, letting these moving averages come down to it, it'll be easier to get over them. Likely start to see that next week and a climb back up in the 10. Otherwise, if these moving averages come down to it, then we're likely to see another, and it can't cross over, then we'll see another expansion lower. Guess it really doesn't matter which way you place it. 104.30 area is that halfback. And even just doing all of yesterday, we've still got 104.25 as a halfback, which is the 3-day too. So it's going to be tricky to get past that. All right, we're not overbought, we're not oversold, we're being carried by the Mag 7. And if they take a break, we're going to stall. We got data coming out. Watch the clock. Gold. Gold made some pretty good moves when US dollar Japan was rocking the boat. 2,500 to set that new line in the sand. And that's like a 2-bar reversal or a tweezer top kind of pattern. It also looks like a blow off top, that last hurrah before everything starts to dump. And right now, just like with the earlier discussions of pure price, we've got 2 lower lows and 1 lower high. If current price right now fails to get above that high, then we'll have 2 lower lows and 2 lower highs, and that's a full set for a trend reversal back down the other direction. We tagged the lower end of the ADR already, and we did it early enough in the day that we could go to the other side, but we've already started this transition over from rising to falling, and we had this very aggressive move last night, almost like a liquidity grab, and we could see this as a gap that needs closed. It's not as aggressive as our typical gap would look, and it lines up. Remember, these opens and closes are different than regular trading hours. So this closed before POW and before FOMC, and we got POW and FOMC, and then it made that big exaggerated move. So it looks like it's unwinding a lot of that. We got VWAP reciprocation. So what we have on the bottom, we could expect off the other side on the top. It's failed in this range for the halfback. And then it legged lower again. So this halfback failed. There's your halfback rejection. Now we've got a whole new range. And that halfback, we're already through it. So we hit it, we stalled out. It was also VWAP. That was a double resistance, and it made it through there anyways, which shows some strength. But now we've still got to be concerned about this previous rejection area, that 24.92. We can measure this entire thing, and we're fighting right now with the halfback. If we can get through this zone, that'll give us our higher high. It'll break the lower high that we need, because right now that's the fear. If we fail to get above that, that'll be 2 lower highs. Once we get above it, though, it breaks that count. That count is done. And we can look to challenge that 2,500 level again. For gold, keep your eye on Japan. It's not perfect, but it's better than nothing. Gold makes moves when Japan makes moves a lot. Yep. All right, everybody, be careful, be safe, watch the clock. I'll see y'all tomorrow.